David, welcome. Are the airlines getting ahead of themselves?
Hey, thanks, Kelly. Getting ahead of themselves or pricing through the turbulence. I think what the market is starting to look at is the possibility that we're moving from pandemic to endemic. And if that's right, the resiliency of travel demand, flush consumers, and a lot of cost potential in these businesses means these stocks can finally start to really work from where we are right now. So the market's looking through the near-term disruption to what a better 23 and 24 could start to look like.
Which I totally understand from a demand side, but I'm reminded by Hindenburg's sell call on Royal Caribbean yesterday, where they said, look, this company is back at pre-pandemic highs, but it has a lot more debt, a lot fewer travelers. Wouldn't the same argument apply to the airlines for a while?
It could in the short term, but I think what a lot of people focus on when you're looking at the stock price, what it was 2019 versus today, what you kind of miss is the overall revaluation of risk assets that's happened because of all the liquidity that's been pushed into the system. The EV to EBITDA multiple, PE multiple, whatever it is relative to 2019 across every sector is higher. The market is valuing cash flow more. It's hard to do that with the airlines right now because we're not in a position where we're making a ton of money. But if we can get there, and again, getting out of pandemic to endemic is the key. If we can get there, they're going to start producing cash again because the competitive environment hasn't changed. Their consumers still value the product, and they've been making changes to the business that's going to result in better cost performance post the crisis.
You know, you mentioned liquidity and how supportive that's been, but that's the one factor that's turning the other direction this year. So could that actually put downward pressure on multiples?
And for the overall market, it will. But I think on a relative basis, as that's happening, if you're starting to think about where you're going to take your money out of things like tech or stocks that have appreciated a lot, where are you going to go into? You're going to start looking for cyclical markets where demand hasn't recovered. And where you're going to start looking at some point is going to be the airlines. Institutional sponsorship on these stocks has been very low coming in over the course of the crisis because we simply can't state with any certainty that the next wave is the last wave. But if we do get to that point, the money will start to flow there because, again, if you look out on 23 and 24 normalized earnings, these stocks are not trading at very, very, very high multiples relative to the broader market.
David, if I'm reading my notes correctly, and there's no guarantee that I am, it looks like your rank preference is for Delta, then American and UAL, and then Love or Southwest. Why are you not as high on Southwest as a lot of your peers are?
Well, Southwest has been a favorite of a lot of analysts coming through the crisis, right? Domestic leisure focus, they're going to be the guys that recover the first. And what we found is actually, coming out of the crisis and coming through the crisis, Southwest has had to actually adjust their network strategy quite a bit. So instead of being very, very deep in a small number of markets that are large, think Chicago to Las Vegas, you're running a high capacity bus in those markets, you can make a lot of money on that. They're having to spread the network a little bit. And that tension between network depth and the breadth that they're putting into the system now is requiring them to make some changes in the way they run their operation. They're having to staff and crew and reserve very differently than they did before. And that's going to take a little bit of a while for them to grow into. So we think that Southwest is in the middle of reinventing itself a little bit during this recovery. We'd prefer something like a Delta where they're executing a pretty well-worn playbook. The share count hasn't been diluted because of issuance of new equities or convertible debt. And the brand premium they have is going to allow them to go ahead and recover, I think, pretty quickly here if we are moving out of this the pandemic.
Just to quick button it up, am I understanding correctly that your concern about Southwest is that they don't have enough of those high traffic routes, Chicago to Las Vegas, and they may have too many of the lesser traffic routes, let's say Baltimore to Indianapolis?
Well, it's a little bit more discreet than that. It's more like Baltimore to Fort Myers or to Sarasota or something like that. And if you look at where Southwest flies today, they actually serve more cities today than they did in 2019. What's happening is because they also do a lot of business travel, right? So Oakwood to Burbank. And when I lived in California, that was a very popular route. Those flights aren't there. The demand isn't there. So they're having to shift to respond to where traffic might be. And that's just going to put a little bit of attention into their business. They're going to have to adjust the way that they run their operations and get their pricing right. I have faith that they'll do it over the long term, but I'd rather just be with a guy that's hitting the ball right down a fairway than a course that they've played before.
I'll tell you, though, Fort Myers sounds pretty good today. We got 6 inches of snow here, man. Thanks very much, David Vernon. We appreciate it.